I'm staring at a screenshot of my crypto portfolio, and it's a mess.
I invested $10,000 in Bitcoin last year, and now it's worth $6,200.
I feel like I've made a huge mistake, but what if I told you that I'm actually relieved?
You see, I've been using a strategy called dollar cost averaging, which means I've been investing a fixed amount of money in crypto every month, regardless of the market's performance. It's helped me avoid the stress of trying to time the market, and it's actually saved me from losing even more money.
I know what you're thinking. Isn't dollar cost averaging just a fancy way of saying I'm throwing money at the market and hoping for the best? But trust me, it's not.
It's a strategy that's been proven to work, even in volatile markets like crypto.
For example, let's say you invested $1,000 in Bitcoin every month for the past year.
Some months, the price would be high, and you'd get fewer coins for your money. But other months, the price would be low, and you'd get more coins.
Over time, the average cost of your coins would be lower than if you'd invested a lump sum at the wrong time. I've seen it work in my own portfolio.
In January, I invested $1,000 in Bitcoin when the price was around $40,000.
I got 0.025 coins for my money.
But in June, I invested another $1,000 when the price was around $30,000.
I got 0.033 coins for my money. So, even though the market was down overall, I was still able to get more coins for my money by dollar cost averaging. Now, I know some of you might be thinking, but what about the fees? Doesn't dollar cost averaging mean I'll be paying more in transaction fees? And that's a fair question.
However, most crypto exchanges offer low or even no fee transactions for regular investors.
For example, I use Coinbase, which offers free transactions for investments over $100. So, how can you start using dollar cost averaging in your own crypto investments? First, you need to decide on a fixed amount of money you want to invest each month. This could be $100, $500, or even $1,000, whatever works for your budget. Then, you need to set up a recurring transaction with your crypto exchange. Most exchanges will allow you to do this automatically, so you don't even need to think about it. For instance, let's say you want to invest $500 in Ethereum every month. You can set up a recurring transaction with your exchange to transfer $500 from your bank account to your exchange wallet on the first day of every month. Then, the exchange will automatically buy Ethereum with that money, regardless of the current price. It's that simple. And the best part is, you can use this strategy with any type of investment, not just crypto. So, whether you're investing in stocks, bonds, or even real estate, dollar cost averaging can help you smooth out the ups and downs of the market and achieve your long-term financial goals. If that just clicked for you, hit like. It tells me to keep making this kind of content. And if you're ready to start using dollar cost averaging in your own investments, I'll link to a guide in the description below that will walk you through the process step by step. Now, I want to ask you, what's the biggest investment mistake you've ever made? Was it investing in a stock that tanked, or maybe putting all your money into a single asset? Share your story in the comments below, and let's learn from each other's mistakes. And if you know someone who's struggling to make sense of the crypto market, send them this video. It might just change their perspective on investing. Finally, in my next video, I'll be talking about the top 5 crypto exchanges for beginners. If you're new to crypto, you won't want to miss it. It's called Crypto Exchange Showdown, which one is right for you, and it's coming out next week. Thanks for watching, and I'll see you in the next video. To further illustrate the power of dollar cost averaging, let's consider a historical example. Suppose you had invested $100 in the S&P 500 index every month for the past 10 years. You would have invested a total of $12,000, and your portfolio would be worth around $23,000 today. That's a return of over 90%, despite the market experiencing several downturns during that period.
In contrast, if you had invested a lump sum of $12,000 in the S&P 500 index 10 years ago, your portfolio would be worth around $25,000 today. While that may seem like a better return, it's essential to consider the timing risk. If you had invested your lump sum in 2007, just before the financial crisis, your portfolio would have been worth significantly less. Dollar cost averaging helps mitigate this timing risk by spreading your investments over time. It's a disciplined approach that takes the emotion out of investing and helps you focus on your long-term goals. For instance, if you're investing for retirement, you may have a 20 or 30-year time horizon. In that case, it's unlikely that the market will be lower in 20 or 30 years than it is today. Another benefit of dollar cost averaging is that it allows you to take advantage of compounding. When you invest a fixed amount of money regularly, you're essentially buying more units of an asset when the price is low and fewer units when the price is high. Over time, this can lead to a significant increase in the value of your portfolio. To give you a better idea, let's consider an example. Suppose you invest $500 in a stock every month for 5 years, and the stock pays an annual dividend of 4%. If the stock price remains constant, you'll have invested a total of $30,000 and earned around $6,000 in dividends. However, if the stock price increases by 50% over the 5-year period, your portfolio will be worth around $60,000, and you'll have earned around $12,000 in dividends. That's a total return of over 120%. Now, I'd like to address a common misconception about dollar cost averaging. Some people believe that it's only effective in bull markets, when the overall trend is upward. However, the truth is that dollar cost averaging can be just as effective in bear markets, when the trend is downward. In a bear market, the key is to continue investing your fixed amount of money regularly, even when the market is declining. This may seem counterintuitive, but it's essential to remember that the market will eventually recover. By continuing to invest, you'll be buying more units of an asset at lower prices, which can lead to significant gains when the market recovers. For example, suppose you invested $1,000 in Bitcoin every month during the 2018 bear market. The price of Bitcoin fell from around $20,000 to $3,000, but you continued to invest your $1,000 every month. By the time the market recovered in 2020, your portfolio would have been worth significantly more than if you had invested a lump sum at the bottom of the market. In addition to its effectiveness in various market conditions, dollar cost averaging also offers a psychological benefit. By investing a fixed amount of money regularly, you'll be less tempted to try to time the market or make emotional decisions based on short-term market fluctuations. This is especially important in the crypto market, where prices can be highly volatile. By using dollar cost averaging, you'll be able to ride out the ups and downs of the market and focus on your long-term goals. For instance, if you're investing in a crypto index fund, you can set up a recurring transaction to invest a fixed amount of money every month, regardless of the market's performance. To take it a step further, you can also use dollar cost averaging to invest in a tax-advantaged retirement account, such as a 401k or an IRA. This can help you reduce your tax liability and maximize your returns over the long term. For example, suppose you invest $500 in a crypto index fund every month in a tax-advantaged retirement account. Over the course of a year, you'll have invested $6,000, and you may be eligible for a tax deduction on that amount. If the crypto market increases in value over the long term, your portfolio could be worth significantly more, and you'll have reduced your tax liability by investing in a tax-advantaged account. In conclusion, dollar cost averaging is a powerful investment strategy that can help you smooth out the ups and downs of the market and achieve your long-term financial goals. By investing a fixed amount of money regularly, you'll be able to take advantage of compounding, reduce your timing risk, and maximize your returns over the long term. Whether you're investing in crypto, stocks, or bonds, dollar cost averaging is a strategy that's worth considering.
To give you a better understanding of how dollar cost averaging works in practice, let's consider a few more examples. Suppose you invest $200 in Ethereum every month for 2 years, and the price of Ethereum increases by 20% per year. At the end of the 2-year period, your portfolio will be worth around $12,000, and you'll have earned a significant return on your investment. Alternatively, suppose you invest $500 in a crypto index fund every month for 5 years, and the crypto market increases in value by 50% per year. At the end of the 5-year period, your portfolio will be worth around $150,000, and you'll have earned a staggering return on your investment. These examples illustrate the power of dollar cost averaging in different market conditions. By investing a fixed amount of money regularly, you'll be able to take advantage of compounding, reduce your timing risk, and maximize your returns over the long term. Whether you're investing in crypto, stocks, or bonds, dollar cost averaging is a strategy that's worth considering. In addition to its effectiveness in various market conditions, dollar cost averaging also offers a high degree of flexibility. You can use this strategy to invest in a wide range of assets, from stocks and bonds to crypto and real estate. You can also adjust the frequency and amount of your investments to suit your individual needs and goals. For example, suppose you want to invest in a crypto index fund, but you're not sure how much to invest each month. You can start by investing a small amount, such as $100, and gradually increase your investment over time as you become more comfortable with the market. Alternatively, suppose you want to invest in a stock, but you're not sure when to buy. You can use dollar cost averaging to invest a fixed amount of money at regular intervals, regardless of the market's performance. This will help you smooth out the ups and downs of the market and reduce your timing risk. In terms of specific numbers, let's consider an example. Suppose you invest $500 in a stock every month for 10 years.